Today, planned wealth destruction continues. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. In this week's market review, we see the negative moves are now compounding as the bears remain in charge, emboldened by fresh statements from central banks about the need to tackle rampant inflation, and even confirming that falling markets are part of the plan. As usual, we'll start with the US markets, as it's really there that sets the tone for global trends. Then we'll cover Europe, Asia and Australia, as well as crypto and commodities. And in fact, on Friday, US stocks pulled back from session lows after the S&P 500 dipped 20% below its January the 3rd closing record. 20%, of course, is defined as bear territory. Treasuries and the dollar gained as havens caught bids. The NASDAQ is, however, already over that bear line by some margin, and we can expect more falls ahead. Overall, the US consumer is deeply negative. While some cross currents are causing the current sell-off, the proximate cause of the recent acceleration in the stock declines revolves around fears about the US consumer, said Glenview Trust CIO Bill Stone. For the first time in the post-COVID period, retailers have been stuck with some excess inventories. Costs due to inflation are also taking their toll on their earnings. And lastly, there is evidence that the lower-end consumer is feeling the pinch from the increase in prices. The sell-off has led to increasing warnings of stagflation and to Wall Street strategists cutting their S&P 500 targets. It's also led to investors scrambling to find places to hide during the downturn. And at the end of another volatile week, price swings were exacerbated by the monthly expiration of options, tied equities and exchange-traded funds. The sell-off has sent the S&P 500 deeper into a 7th weekly decline that would make the longest losing streak since the dot-com bubble burst more than 2 decades ago. It will be just a 4th streak of 7 or more weekly losses in the post-World War II period, according to Bespoke Investment Group. It's a small sample size, but these types of streaks haven't occurred during particularly positive periods for the equity market, wrote the firm's strategist in the note. The root causes of the weakness have been the hawkish FOMC and increasing concerns over the potential for a recession. And in a week marked by buy and dip, sell the rally price action, investors grappled with concerns about an economic slowdown and retailers signalling the mounting impact of high inflation on margins and consumer spending. Sentiment got a boost early on Friday, though, after Chinese lenders lowered the 5-year loan prime rate by a record amount in an effort to boost mortgages and loans amid a property slump and COVID-19 lockdowns. I'll talk about that down the show. But note the contrast in interest rate trajectory compared to the Fed. St. Louis President James Bullard said the central bank should front-load an aggressive series of interest rate hikes to push rates to 3.5% at year's end, which, if successful, would push down inflation and could lead to policy easings in 2023 or 2024. I've also said we should get to 3.5% by the end of the year, which is higher than some of my colleagues, he said in an interview on Friday. The more we can front-load and the more we can get inflation and inflation expectations under control, the better off we'll be. And in the out years of 23 and 24, we could be lowering the policy rate because we got inflation under control. Bullard, who's been the most hawkish among policymakers this year, repeated his support for Fed Chair Jerome Powell's plan to raise rates by 0.5 point at the Federal Open Market Committee meeting in June and July as part of an effort to cool inflation, which is running at its hottest since the 1980s. And interestingly, asked about a 75 basis point hike, Bullard said that couldn't be ruled out as an option. So at the end of the week, the Dow Jones Industrial Average gained 0.03% to 31,261. That's down 40% year to date, down 8.6% from a year ago, and up 21.3% from 3 years ago. The NASDAQ fell 0.3% to 11,354 to be down 3.8% over the past week, 27.4% for the beginning of the year, and down 15.7% from a year ago, although it is still up 46.5% from 3 years back. And the S&P 500 closed up 0.01% after recovering from an intraday slump that pushed losses since its recent peak above 20%, so into bear market territory. In fact, it was down at one stage 2%. And for the week, it was 3.1% lower, down 8.7% for the month, 6.1% over the past year, and up 36.6% from 3 years ago. Real estate, healthcare, and energy helped the broader market recover, with the latter underpinned by a climb in oil prices, which racked up their fourth weekly gain in a row for the first time since mid-February. Technology also played a role in the rebound as investors bought the dip in big tech, with Apple cutting losses to end in the green after falling more than 2%. It ended up 0.17% to 137.59, but down 6.5% over the week and down 22.5% year to date. Meta Platforms ended the day up 1.18% to 193.54, but down 42.5% year to date. Consumer discretionary had earlier led a sea of red on Wall Street after quarterly results from corporates continue to flag the impact of inflation, just as the Federal Reserve shows little sign of slowing down rate hikes. Within the last week, Walmart, now the fourth largest stock in the major consumer staples ETF, reported Q1 results that featured a massive inventory build. It was a sign of dismal operating execution. It also said that overstaffing was a significant contributor to a big margin miss. Then Target added to the retail turmoil by posting profit results that missed analysts' expectations and cited big transportation costs that it might absorb rather than pass along to the consumer. According to the Wall Street Journal, the retailer went on to endure the second worst day in its history. Only Black Monday back in 1987 was more grim. In fact, Thursday's 6.43% plunge was a worse day for the staples sector than any other single session during the great financial crisis, all caused by just a pair of corporate earnings reports. So you can see how fractious the markets are. Ross Stores plunged more than 22% after first quarter results fell short of Wall Street estimates, and the off-price retailer cut its guidance amid pressure from higher transportation and labour costs. And Deere, meanwhile, reported quarter results that missed on the top line and highlighted the impact of inflation and supply chain issues ahead, sending its shares more than 14% lower. Foot Locker bucked the trend, though, ending the day more than 4% higher after the footwear retailer reported better than expected profit that helped foreshadow softer revenue and same-store sales. And interestingly, the eighth straight weekly slump for stocks have some speculating whether a bottom will soon be reached, or is there still more pain ahead as investor capitulation has reached the levels of prior market downturns. We've been encouraged by the breadth and manic selling activity occurring in a few days throughout the recent correction cycle. However, we are not yet seeing comparable capitulation metrics relative to the 2018 or 2020 market downturns, Jenny Montgomery Scott said in the note. This suggests to us that even though we are in or close to a bottom range, we may have to experience more volatility before the markets are thoroughly washed out, he added. The Federal Reserve's determination to raise interest rates until it squashes the highest inflation in decades is darkening the outlook across Wall Street as US stocks stand on the cusp of a bear market and warnings of recession grow ever louder. At issue is a so-called Fed put, or investors believe that the Fed will take action if stocks fall too deeply, even though it has no mandate to maintain asset prices. One off-sided example of the phenomenon, which is named after a hedging derivative used to protect against market falls, occurred when the Fed halted a rate hiking cycle in early 2019 after a stock market tantrum. But this time around, the Fed's insistence that it will raise rates as high as needed to tame surging inflation has bolstered the argument that policymakers will be less sensitive to market volatility, threatening more pain for investors. And a recent survey by Bank of America Global Research showed fund managers now expect the Fed to step in at 3,529 on the S&P 500. compared with an earlier expectation of 3,700 back in February. Such a drop would be a 26% decline from the S&P's 3rd of January closing high. The Fed has bigger fish to fry, and that's the inflation problem, said Phil Orlando, chief equity market strategist at Federated Hermes, who is increasing his cash levels. The Fed put is kaput until the central bank is confident that they're no longer behind the curve. So as a result, some investors are digging in for a long slog. Bank of America's survey showed cash allocations at a 2-decade high, while bets against technology stocks stand at their highest since 2006. And strategists at Goldman Sachs, meanwhile, earlier this week published a recession manual for US equities in response to client inquiries on how stocks will perform in a downturn. And Barclays analysts said that numerous negative near-term catalysts meant the risks for stocks remain firmly stacked to the downside. Jason England, global bonds portfolio manager at Janus Henderson Investors, believes the index needs to fall at least another 15% for the Fed to slow its tightening, given that the unprecedented monetary policy support helps stocks more than double from their March 2020 lows. The Fed is being very clear that there will be some pain ahead, he said. In the past, rising uncertainty and mounting recession risks have had important effects on investor psychology, making markets less tolerant of monetary policy tightening that it seems as no longer warranted. IIF analysts wrote on Thursday, the risks of a similar market tantrum to 2018 is rising again now as markets fret about global recession. Now, there have been signs of resilient sentiment among investors. For example, the volatility index, known as Wall Street's fear gauge, is elevated but below levels it reached during previous major sell-offs. It stood at 29.43 at the close, still higher than the start of the year, but not currently in red alert territory. And by the way, the ARK Innovation Fund, which became emblematic of the pandemic rally, has brought in net positive inflows of $977 million over the past 6 weeks, despite the fund being down 57% in 2022. While some investors say there are signals that markets are yet to bottom, others are actually more hopeful. Terry Spath, Chief Investment Officer at Zuma Wealth, believes some investors are re-entering parts of the stock market that have suffered outsized losses. The Fed is already seeing signs that they won't be needed as a buyer of last resort, she said. Analysts at Deutsche Bank are much less optimistic. The Fed, having badly erred on the side of excess inflation in 2021, cannot afford to make the same mistake twice, which favours more financial condition tightening and ongoing high volatility, panicky markets, they wrote. One last volatility catalyst to keep in mind is JP Morgan & Chase's Investor Day on Monday, following news that shareholders voted down CEO Jamie Dimon's pay package. There could be more unexpected words expressed by analysts and executives at the event, and if so, impacts might be felt across the financials sector. Now, European stock markets traded higher on Friday, ending the week on a positive note, with investors buoyed by strong UK retail sales data, as well as China cutting a key lending benchmark. The DAX in Germany traded up 0.72% to 13,981, while the CAC 40 in France rose 0.2% to 6,285, and the FTSE climbed 1.19% to 7,389. European equities received the boost after China cut its 5-year loan prime rate by 15 basis points on Friday, the largest cut on record, and that comes as Beijing seeks to revive the troubled housing sector to prop up the second largest economy in the world. Investors appear more optimistic this morning after a volatile week as China takes its latest step to bolster the country's economy, Stifel said in a note. Adding to the positive tone was the news that UK retail sales rose 1.4% on the month in April, in contrast to expectations of a further 0.2% decline as a result of higher spending on alcohol and tobacco in supermarkets, as well as stronger clothing sales. That said, market research firm GfK said UK confidence is now at an all-time low, despite the fact that unemployment is at a 50-year low due to rampant inflation. And of course, the Brexit issues rumble on. Further evidence of this emerged on Friday as German factory gate prices rose again in April, climbing 2.8% on the month. That's a hefty jump of 33.5% on the year. And in the corporate sector, Richemont stock slumped over 10% after the Swiss luxury goods group said discussions about its luxury new retail partnership were still ongoing, even as it reported strong American demand for its jewellery and watches. Zurich Insurance stock fell 0.4% after the Swiss insurer announced Friday that it agreed to sell its Russian businesses to members of the local team, becoming the latest company to announce its exit from the Russian market. And oil prices edged up on Friday as concerns about weaker economic growth eclipsed expectations of a demand rebound in China as the world's top crude importer eased some COVID-19 lockdowns. WTI was actually down 0.1% across the week and up 73.6% from a year ago to settle at 110.35. Investors, worried about rising inflation and more aggressive action from central banks, have been reducing their exposure to risky assets. Additionally, gold futures rose 0.21% to 1,845, up just 0.9% this year, while the euro-US dollar traded 0.23% lower at 1.0562. And just to add insult to injury, the World Health Organization held an emergency meeting on Friday to discuss the recent outbreak of monkeypox, a viral infection more common to West and Central Africa, after over 100 cases were confirmed or suspected in Europe. In what Germany described as the largest outbreak in Europe ever, cases have been reported in at least 9 countries: Belgium, France, Germany, Italy, the Netherlands, Portugal, Spain, Sweden, and the United Kingdom, as well as in the United States, Canada, and Australia. Spain reported 24 new cases on Friday, mainly in the Madrid region, where the regional government closed a sauna linked to the majority of the infections. And a hospital in Israel was treating a man in his 30s who is displaying symptoms consistent with the disease after recently arriving from Western Europe. First identified in monkeys, the disease typically spreads through close contact and has rarely spread outside Africa, so this series of cases has triggered concern. But scientists do not expect the outbreak to evolve into a pandemic like COVID-19, given the virus does not spread as easily as SARS-CoV-2. Monkeypox is usually a mild viral illness characterized by symptoms of fever as well as a distinctive bumpy rash. This is the largest and most widespread outbreak of monkeypox ever seen in Europe, said Germany's Armed Forces Medical Service, which detected its first case in the country on Friday. There appears to be a low risk to the general public at this time, a senior US administration official said. Still, the World Health Organization's European chief said he was concerned that infections could accelerate in the region as people gather for parties and festivals over the summer months. There's no specific vaccine for monkeypox, but data shows that the vaccine used to eradicate smallpox are up to 85% effective against monkeypox, according to the World Health Organization. And British authorities said they have offered a smallpox vaccine to some healthcare workers and others who might have been exposed to monkeypox. Since 1970, monkeypox cases have been reported in 11 African countries. Nigeria has had a large ongoing outbreak since 2017, and so far this year there have been 46 suspected cases, of which 15 have since been confirmed according to the WHO. The first European case was confirmed on May the 7th in an individual who returned to England from Nigeria. Since then, over 100 cases have been confirmed outside Africa, according to a tracker by a University of Oxford academic. Many of the cases are not linked to travel to the continent, and as a result, the cause of this outbreak is unclear, although health authorities have said that there is potentially some degree of community spread. Now, in Asia, as I discussed, China cut its benchmark reference rate for mortgages by an unexpectedly wide margin on Friday. That's its second reduction this year, as Beijing seeks to revive the ailing housing sector to prop up the economy. Senior officials have pledged further measures to fight a slowdown in the world's second biggest economy, hit by COVID-19 outbreaks that prompted stringent measures and mobility restrictions and caused huge disruptions to activity. Many market participants believe Friday's move was also a response to the Chinese Premier Li call to decisively step up policy adjustments and let the economy return to normal quickly. Today's reduction to the 5-year loan prime rate should help drive a revival in housing sales, which have gone from bad to worse recently, Julian Evans-Pritchard at Capital Economics said in a note. But the lack of any reduction in the 1-year prime rate, the LPR, suggests that the PBOC is trying to keep easing targeted and that we shouldn't expect large-scale stimulus of the kind that we saw in 2020. The LPR is a lending reference rate set monthly by 18 banks and announced by the People's Bank of China. Banks use the 5-year LPR to price mortgages, while most other loans are based on the 1-year rate. Both rates were lowered in January to support the economy. China, in the monthly fixing, lowered the 5-year by 15 basis points to 4.45%. That's the biggest reduction since China revamped the interest rate mechanism in 2019, and more than the 5 or 10 basis points that was tipped by most economists. The 1-year LPR was unchanged at 3.7%. China's economy, a key global growth driver, is widely expected to shrink this quarter from a year earlier, compared with first quarter's 4.8% growth, with the property sector seen as a key drag on growth on the back of COVID-related mobility restrictions. The move failed to excite mainland-listed property shares, which were flat, although Hong Kong-listed developers inched up just slightly. The cut to the floor of mortgage rates for some home buyers, which Goldman Sachs estimates will be first home mortgage rate floors, lowering to 4.25% from 4.4%, will not ease the financing stress for developers, many of whom are struggling to refinance debt. And while property shares have rebounded recently, the muted reaction to Friday's cut suggests some investors think it may not be enough to revive the struggling sector. Policymakers are trying to drive a turnaround because property and related industries such as construction account for more than a quarter of the economy. But China's property sales in April fell at their fastest pace in around 16 years, while new home prices declined for the first time month on month since December, hurt by weak demand amid wide COVID-19 lockdowns. Policymakers may have reached a consensus on whether to revive the property sector, said Xing Zhihing, senior China strategist at ANZ, predicting further easing measures. The central bank has pledged to step up support for the slowing economy, but analysts think the room to ease policy could be limited by worries about capital outflows as the Federal Reserve raises interest rates. Capital Economics believes the lack of the 1-year LPR cut suggests the central bank may be concerned about the potential impact on capital outflows and the yuan. Friday's cut suggests that China's economic growth was facing increasing resistance this year, said Marco Sun, chief financial market analyst at MUFG Bank. And a campaign by the authorities to reduce high debt levels became a liquidity crisis last year amongst some major developers, resulting in bond defaults and shelved projects, shaking global financial markets. And since the end of last year, Beijing has taken steps to help revive the property sector. Those include making it easier for large and state-owned developers to raise funds, relaxing rules on escrow accounts for pre-sale funds, and allowing some local governments to cut mortgage rates and down payment ratios. Stocks had made a positive start to the day after China's move to cut a key lending benchmark to support its economy, which will be impacted by recent lockdown measures in Shanghai and elsewhere, and also perhaps help to ease fears about slowing global growth. But also note that China is looking to stock up on its strategic crude stockpiles with cheap Russian oil, a potential sign that it is strengthening its energy ties with Russia as the European Union works towards implementing sanctions on Russian imports in response to the war. China's Shanghai Composite was up 1.6% to 3,146. That's down 13.6% year to date. And Hong Kong's Hang Seng Index jumped 2.96% to 20,717. Japan's Nikkei 225 was up 1.27% to 26,739, where the Consumer Price Index grew 0.4% month over month in April 2022, while the national core CPI grew 2.1% and the national CPI grew 2.5% year on year. South Korea's Kospi rose 1.81% to 2,639 and is down 16.4% year to date. Now in Australia, Australia's share market was swept up in that relief rally on Friday after China cut that key lending rate, providing nervous investors much needed assurance that Beijing intends to support the economy and rescue the stricken property sector, although, as we said, they may be limited. Australian shares rebounded strongly on Friday after that cut, and as a result, the S&P ASX 200 climbed 1.2% to 7,145, lifting its weekly advance to 1%. It was the benchmark's first weekly gain since the middle of April. The local market shook off a weak lead from Wall Street to jump 0.7% at the open and extended those gains after the rate move. The announcement triggered a spike in metals and iron ore prices, supporting ASX miners, with BHP adding 2.1% to 47.18. Rio Tinto firmed 1.5% to 108.35, and Fortescue climbed 3.9% to $20.15. The technology sector rallied 4.6%, led by a 21.1% leap by Life 360 to 389 after it reaffirmed revenue and earnings guidance at its annual general meeting on Friday. And Nova next added 11.7% to $4.11, and Block jumped 9.9% to $127.64. Shares in Chalice soared 19.1% to $6.81 after the company said it has received the final outstanding approvals to conduct low-impact exploration drilling at the Hartog Dampier targets within its Jumiar operations. And Woolworths edged 0.5% higher to 35.35 after lobbing a bid to buy the 80% of mydeal.com.au, not owned by its management, that values the online marketplace, debt inclusive, at $243 million. And IGO said it had successfully produced battery-grade lithium hydroxide from the Kwinana refinery. Its shares jumped 5.1% to $11.66. And all four major banks posted modest gains, with Commonwealth Bank up 0.8% to $104.60. Westpac was up 0.5% to $23.57. National Australia Bank climbed 0.7% to $31.07. And ANZ gained 0.9% to $25.50. And finally, Bitcoin was sitting at 29,265, down 36.6% from the start of the year, but it's still up 284% over the past 3 years. And as I discussed recently with John Adams on the Interests of the People channel, there are some big questions that we should be asking about crypto. Check that show out if you want some contentious ideas to digest. And Ether was down 2.67% to 1,966, and also down 46.6% from the start of the year, although it's still up 707% over the past 3 years. And more broadly, this year continues to feature astonishing single stock moves that cascade into broad market sell-offs. Still, sharp, short covering rallies from just a positive whisper can spark impressive upside moves. This kind of volatility makes all the more important that money managers have constant access to the most accurate corporate event data. And risk management might be the theme, actually, of 2022. And traders are again reminded of how important one disappointing earnings report or even cautious words from an executive can be. As earnings season ends, investors look back on the last 6 weeks in awe of the many single stock plunges and their market-wide impacts. The risk as a result of information released during key corporate events is a clear and present danger, and it seems no stock, apart from maybe the energy sector, is left unscathed. But this, to me, underscores the skittishness of the markets at the moment, and I still believe that there is more downside ahead, so those who think they have spotted the bottom so far are probably fooling themselves, or indeed fooling their clients. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.